This market is insane. Don't believe me? How about him?
Insane, insane, insane.
That's right. This market is insane, keeps going up. How? Why? But are we seeing cracks? Lots to go over today. Sit back. Let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Also, if you find this video of value, please do consider subscribing, hitting that like button. So, is this market insane? Without question. For starters, I'm changing my opinion. What happened in February, I'm going to call it a flash crash. We have come back, soared back. But why? How with these fundamentals being so awful? So today, as always, we're going to go through the big charts, show you our signals. Then, what's on our radar? Lots of stuff. You can make monies in other areas than tech. Next, what keeps me up at night? Just a few things. Then our game plan going forward. Let's go to the big charts. First up, if you're new here, welcome to the group. About 18,000 strong now. Thank you so much for that. But let's go through our process. It's going to be a combination of what's happening with the fundamentals, the cycles, and the charts. The charts always confirm my decision. So first up, we take a look at the monthly view. What do we see? Pretty much the same thing as last time. Obviously, it's positive. This, if you're new, is called negative divergence. That is relative strength. And you can see when we hit our highs back in 2019, we had a lot of strength. But as we've continued to go higher, less strength, not a good sign. But of course, that is positive. But here, I'm going to call this the most important chart today to follow and watch. Why? Same thing, monthly chart. I'm going back to 1981. See that line? Oh boy, let me get rid of that. Actually, it worked out well. Below it, above it. So we've been below this trend line of 81. We broke above it during the dot-com era. We are right on it, okay? So this month has to be month end. Can we break above? Who knows? The momentum in this market, or do we come back and challenge the line below from 2008? So really going to continue to watch that one. All right, next up, weekly chart. What do we see? Obviously, this is positive as well. You can see our trend line here going back to 18. We're up against it. We're getting pretty overbought relative strength on the weekly chart. Nonetheless, it is in fact positive. So short term, what do we see? Lots, okay? The biggest thing is here. Now I use a 5-day relative strength, okay? We are at 98, well, we came down. We hit 94 RSI last week. That is hugely overpriced. That is why I took profits across the board on my large caps and techs, raised some cash, went to about 10% on Friday. Okay, so I'm really concerned about that. Yesterday, you see we came down. But that being said, last video, you saw what happened, okay? What? We had month-end markup, options expiration, and then today is a rebound day. So I never make moves in the first and second of the month. I'm going to wait till this settles out, and then I'm either going to deploy those assets, the cash meaning, into other sectors, or maybe I'll start hedging the market if we see some breakdowns. From there, the biggest thing, volatility, okay? So we've had 8 straight up days until yesterday in the S&P. Think about that. Take a look here, right? This is the volatility index. It has surged. So, kind of funny that stayed there. We've had lower volume, higher volatility. Those two are not good signs. That's showing an exhaustive market. The other thing I saw this morning was the cost to hedge, the market has become much more expensive. So really going to continue to watch that one as well. Next, the broad market. This is really what you have to look at, okay? Because you look at just the S&P, driven by 5 companies. Obviously, we know the biggest one, okay? We're still not at all-time highs. We have about 10% to go on the broad market. We see here at relative strength, it failed at the top end and is coming down. While the S&P was down a little bit yesterday flat, the New York Stock Exchange overall was down, okay? Now here's another thing. New chart, I'm showing this, so what's happening below? So this line is your NYSE. This is advances minus decliners. Top, 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 right? So these are lower highs. All of those don't bode well. So yesterday, we had 1,206, right? Advanced decliners, more decliners there. So we're seeing a pattern of exhaustion in this market. We'll continue to watch that. The next thing is, look, this market is thin, entirely too thin, driven by 5 stocks, okay? Very similar to 29, very similar to 2000. Speaking of that, I just did a video on the Fed, and I'm going back and forward. Part 1 is right here, where I discuss each of those periods. But what this shows is a standard allocation, okay? I took this from Fidelity, mixed between Treasuries, S&P, NASDAQ, small, mid, value. Who's up? Obviously the NASDAQ. S&P, how about Treasuries? Now I could add gold in there and really show you the picture, but the bottom line is everything else, minus 20, minus 12, minus 8. Everything else is still down, so this asset allocation theory is still not doing well. Now, maybe you're young and you're 100% in the NASDAQ. Good for you, but when you're managing money for retirees, we just don't do that. So another big move last week was the Treasuries, okay? To me, this was an opportunity. This is our cycle 3, and you can kind of see each time we hit a top, I added. When we were down here, I sold. We hit 0.55 on a 10-year, took some profits, waited, went back up to the top end, still anticipate this to go lower, so we're holding out on that. Still like Treasuries going forward. Also, like a lot of sectors. So now, let's do Sector Spotlight. Before we start Sector Spotlight, big announcement, starting a new playlist, new videos here on our channel. Our audience are Gen X baby boomers. We're coming out with reviews of some texts and other thing. Here's a video announcing that. More to come. So, the big thing, cycle 4, cycle 3, we'll discuss that at the end, but obviously this is really driving us right now. Cycle 4, dollar goes up. Cycle 3, dollar goes down. Now, as you see by the image Andrew's bringing up, the Fed has just made it official. We started back in June. They are committed to driving, devaluing the dollar, and rising inflation, okay? So our call there a month ago, the idea is front run the Fed. We were very fortunate to do that. Dollar goes down. This is commodities. You can see it. We got in right about there, about 3rd week in July. So the next question is, how far can a dollar go? How low can you go, right? Look at this. You see the dollar. This is a monthly view. Well, guess what? We just broke trend, and you can see how low it's gone in the past. So who knows? They're committed to devaluing it, rising inflation. So if this continues to go, that of course is going to help our inflation play. And here it is, right? In this case, I took the commodities. All right, there's a basket of them. You can look it up. I'll show a couple in a second. This is a weekly view. You see the 2 channels. We broke again here, so we broke channel on dollar going down. We broke channel going up on commodities. That is a good sign. Look at this, 1, 2, 3, 4, like 8 weeks in a row, commodities were up. That's just yesterday down 0.15. Not worried about that because actually some of them did pretty well. So let's talk specific. 2 weeks ago, what did we say? We said, you know what? This is getting a little expensive. We took some profits. We're waiting. You can see what's happened here. Still like lumber, big time, supply, demand. Lots of demand right now with housing. So just waiting for that next entry. And if I were to come down here, you're going to have a little bit of a pause in the momentum. That's not a bad thing after a big run. Gives you an opportunity to get in if you weren't there, or add to your positions if you'd like to. So this is something else we talked about last video. I said, okay, see this, folks? That's called a bullish flag. Looks like an F, but I could, right? I said, that's a bullish flag, all right? And I said, that is very good sign. We actually added to our copper holding at that time, and guess what? It's worked out. That's how you do it, okay? My son just opened up his first account a couple weeks ago. He bought something, it was looking like this. He goes, should we really hold on? I'm like, that's a good sign. Let's be patient. He got a breakout. Of course, he wanted to add to that breakout and sell the other one, but that's a story for another day. So really like the way copper is. I think we have a little further to go. In fact, all commodities are up today. Dollar hit a 2-year and cycle low this morning. Continue to like this trade. With that, have had questions about oil, okay? Obviously, one of the biggest commodities. As you see, it's really gone nowhere, okay? So when I look at oil, there's a couple things we look for. Well, yeah, it's kind of doing nothing here. You can go down a little bit. A couple other things I look for. There's your momentum, nothing, right? So the opposite of lumber, not a lot of demand right now because people aren't traveling, using as much gas. Continue to watch it. It is, in fact, one of the sectors that's on my radar, but I don't like it. The other thing is you still have, that's oil volatility above 30, so still waiting, not there. Let's see what happens, okay? Everyone's favorite subject, gold. Okay, what has happened here? Again, very fortunate, what I discussed last time. We had this big run, we took some profits, okay? We were able to hold here, okay? So now, if I scroll, let me come down here a little bit, okay? If I scroll here, and you can zoom in, that's momentum, okay? Momentum is starting to go up. Volatility is down on gold. I think that we are ready for our next breakout. Now remember, we took profits here and bought gold miners here. Again, dollar down. Okay, both of these, gold and gold miners, are up today. Also looking a little frothy. We'll see there, but another good move with our dollar play. All right, and the same thing here, long term, it shows you that we had a big time breakout on the monthly chart going back to 2011. So all of that is very, very bullish for gold, okay? Last up, patience. Sometimes we have to be patient. So I talked about this last time, which was biotech. I had actually added here, okay, on biotech. It wasn't working out. It was starting to break down, but discipline, no emotion. You pick your targets, you have your price, you follow the charts. Okay, same thing here. If I zoom in, you can see, it's kind of scraggly, you can see that momentum was getting better. So I was waiting, right? We hit our support there, and then had a little bit, started going up, and then boom, we had the big move yesterday, up almost 2%. Hopefully that's a sign of things to come. We do have our 50-day here, which is going to be your next resistance. But if we break above that, I think we have a way to go in biotech. All right, so next up, don't forget to subscribe and like this. Also, we're going to go to what keeps me up at night and then our game plan. Let's go. Starting, what keeps me up at night, as always, I want to finish up here with the cycles. Again, this is a great way to utilize our investments, and you saw it, okay, because right now we're in cycle 3. growth slows. Hello, inflation accelerates. Thank you, Federal Reserve. They're neutral. Market stagflation. We're going to see about that. But with that, all those asset classes I showed earlier, the dollar, commodities, and by the way, tech, all do very well in cycle 3. So first up, a couple funny things here from our friends at Hedgeye. I'm jobless, I'm clueless, that's the Fed. And this came out yesterday, I thought it was great. The dollar going downhill in the consumer, because remember, if dollar's down, inflation goes up, that means prices are rising for all of these unemployed folks, which is what I'm going to start with first, okay? You hear the CNBC number. This comes out every Thursday morning, okay? 1 million. They never talk about the pandemic, PUA number, which is those underemployed, self-employed, etc. So last week we had 1.6 million. This number is getting a little bit better, but it's still 27 million, okay? The other thing is we're starting to see a lot of white-collar unemployment starting. You saw the airlines last week. So as we said, we feel that we're going to come down, maybe that 25, and unfortunately level off there as we head into the fall. So with all those unemployed, not unexpected, here's our delinquency rates. It's really starting to surge. Not unexpected, as I said. We'll see that. Now keep in mind, they're letting some people miss their payments. That program is going away. And obviously, because of that, consumer sentiment continues to be very low. So we have to be really aware of that. People are not happy right now. Kind of see that out there. Then you look at the commercial mortgage-backed securities and delinquencies. So real estate, okay? Across the board, obviously, lodging, 25%, retail, multifamily, office, another big part of the market. The Fed has tried to help some of this. But as I've always said, they can help with liquidity. They're not going to help with solvency. Going to continue to watch that. The second most important chart, because this has gotten way worse than even just a couple weeks ago. So I talk about this, okay? Red is considered overvalue. So PE, price earnings, okay? Red is overvalue. 15 is fair value, meaning that is the long-term average of the S&P. And then 10 is undervalue, which we've seen in some other markets. Now, as of yesterday, just think about this. Overvalued after yesterday's close, which August was the best month since 1984. How? I don't know. We're in it, but it doesn't make sense. 33%. To get to a 20 overvalue in the S&P, you would have to have a 33% loss. Fair value, 50%. Not saying it's going to happen, okay, but we have to be aware of how far this market's gone, how overpriced it is. You can see here in the .com, okay, with 20 overvalue, look where we are now. Look at that stretch, okay? Massive between the two. This is really what concerns me. .com real estate. And we call this, of course, the Fed bubble. So, what's next? There's not a V-shaped recovery. I don't care what anybody says on CNBC. Has the market came back? Yes. That's why I'm calling that a flash crash. I think we're going to see a double, multiple waves going into a fall, a lot of stuff going on. Let's be aware of that. Look to take profits, okay? So that's what I did last week. We're about almost 11% in cash right now. Opportunities, look for those asset classes that are not correlated, okay, with the dollar. Here's a quick little chart I'll show you, but obviously commodities and then stay-at-home stocks. Think about that. Talked about volatility. It's really starting to rise. Our magic number is 31. If we get above that, we're out. Then let's take a look at this. Historically, this is called a seasonality chart. Going back 20 years, you can see September is minus 0.6%, okay? 58% of the time. This is the time of the year we get into more volatility. Let's see, but this is another reason why I'm being a little bit cautious. So finally, Follow us for updates. It's real important. Very active on Facebook. I can communicate there, can have comments here on Twitter as well. Hopefully, as always, we've helped educate and inform. Michael Loftus, Wealth and Wisdom TV.